So first, today we're going to talk a little bit about insurance, but not just the overview basics. We're going to boil down into some of the issues and concerns that our agency has found with numerous policies and the actions we've taken to kind of correct those. So if you're with our agency already, you can rest assured that we've gone through this and taken care of that. If you're not with us or you shop insurance, which we do recommend that happens, these are things that you need to be aware of and look out for. Someone was kind enough to put pictures up of Wendy, Sherman, and I. So overview, what does your basic policy not cover? Does your policy exclude coverages for things that homeowners may do? How do rentals affect your insurance? Are there gaps in your directors and officers coverage? So what does your policy not cover? The basic policy does not cover everything. So we add what we call endorsements to the policy to make up that lack of coverage. Ordinance or law. Anyone know what ordinance or law is? Heard the term before? Yeah. So your condo was built in the 1980s. We have a firewall every fourth unit. The association suffers a loss, and it affects 4 out of 12 units in a building. You guys start to rebuild, the city local ordinance comes in, and they say now that you're rebuilding, you need a firewall between every unit. Your basic policy isn't going to pay for that. Your basic policy is only going to pay for the damage and to rebuild the building the way it was before. So we have to have funds to cover that. When you look at ordinance or law, the first coverage A comes into play when the city says you have to tear the whole building down. So your base policy has some coverages there to tear down the damaged portion, but it has no coverage when the other portion has to be torn down and rebuilt, right? So we have a $4 million building, half of it's destroyed. We can reasonably assume we have about $2 million of coverage to rebuild the part that is damaged. The city says you have to tear the whole thing down. Where's the other $2 million going to come from to rebuild an entire building? The ordinance or law would have to be on the policy to make that happen. Part B is the money to tear down that half that was never damaged, that the city is forcing you to tear down. And in this instance, Part C would be a stated limit, maybe 100,000, maybe 250,000, to pay to add the additional firewalls in between every unit now that you're required in that building that was damaged. For water backup, it's been raining all week. John comes home, he comes home from work, he finds that his sub pump and his unit stopped working. There's 3 inches of water. John calls the association, tells them they need to come out and clean it up. Association tells John they're not responsible, and he's on his own. So the first question is the association responsible? Depends on the bylaws, but in most bylaws, even if there's a finished basement, the association has the responsibility to dry the water out. If they don't dry the water out and mitigate the risk, and mold gets on the floor joists, which are association responsibility, the association now has to do a mold. 90% of the time, and again, it's on a case-by-case basis, when we have to go through the bylaws at the time of loss, but 90% of the time, the association is actually responsible to get the water evacuated and the basement dry. If the basement had an upgrade or a finished basement, the association may not be responsible for those, and in most cases, they're not. The second question is, do you have coverage? Water backup is an endorsement. It is not covered on the base policy. A lot of associations believe they're not responsible for the interior of the unit or the water in the basement, so they never think to get the water backup covered. So going through the bylaws on a case-by-case scenario is really important. Multiple deductibles. This happens with water backup, ice damming, and frozen pipes. So the water backup not only affected John's unit, but Mary and Helen's as well. You have a $5,000 deductible, or a $10,000, or even a $25,000. Do you have a deductible for every basement that was affected? Some policies have that stipulation. Ice damming. 12 units on the south side of 3 buildings suffer damage due to ice. So it's the south side because the sun hits it. So 12 units are damaged. A lot of policies have an ice damming per unit deductible clause. So $5,000 per unit, $60,000 deductible. That could add up really quickly, so we want to make sure we don't have that in the policy. Frozen pipes, weathers drop below 0 or 3 days, warms multiple pipes, breaks are discovered. Some are in the same unit, some are in the same building, some are in multiple buildings scattered across. Is that one occurrence or multiple occurrences because it's multiple pipes? Different carriers look at that differently. The carriers we use have agreed that the freezing that caused all of the pipes to happen is the occurrence, not the pipe breaking itself. So we don't have 15 different deductibles being applied to one large loss in multiple buildings. Homeowners' actions not covered. How many times do you guys have homeowners that just do whatever they want? Right? You fine them, it doesn't matter. Give them notices, they still do it. You pass resolutions about barbecues and those things, and they still happen, right? So failure to maintain heat, a vacant unit, leased without the association's approval. John's barbecue, barbecues Nancy's artwork. These are all things that happen. Question is, are you going to be responsible for that? One, and are you going to have coverage? So rentals. Who has rentals? Almost everybody has rentals now, right? When we talk about rentals, we're asking the question, are you a condo association or are you an apartment? Carriers don't have a stated limit, but they do treat you differently the more rentals you have. So White House Acres Condominium allows homeowners to rent their units. Insurance is up for renewal. They receive quotes from 3 carriers. They go with a proposal at $6,000 less. 4 months later, they have a building burnout. The carrier does an investigation. They find out that 8 of the 12 units in that building are rented, and overall, 80% of the association are rentals. Will the carrier treat you differently or cancel coverage? Any thoughts? For sure. So does the association have coverage for the fire? Question's going to be, was the association ever asked how many rentals do they have? And did they answer that line? What if the agent didn't tell the carrier? Does the carrier honor that claim and then go back to the agent? The association allows rentals, but they don't have a cap. So the first one, the carrier is going to treat it differently. Whether they pay the claim or not, they are most likely canceling after that claim. Does the association have coverage for the fire? And that's going to depend on whether the agent asked you that question or not, whether that question was answered truthfully. Did the agent tell the carrier? So if the agent didn't tell the carrier, but you answered it truthfully, you'll most likely have coverage. The only problem is you're not going to get coverage very easily starting on day 1. I know Neil talked about a fire in a building and how long that takes. In this 12-unit building, there will be 14 fire investigations before we can even remove the caution tape and start tearing the building down. Every unit owner's carrier will do a fire investigation. We will do our own fire investigation, and the fire marshal is going to do a fire investigation. That's somewhere between 30, 60, 90 days if we're really slow getting reports back before we can even start to agree on a scope to rebuild this building. Now add in that your master carrier isn't even sure if they want to cover this claim because they're not really sure who lied about the rentals in the first place. At the end of the day, if you guys told them you had 80%, you will most likely have coverage. But it's going to take a while. And once that happens, you will be canceled. The association allows rentals and has no cap. So carriers look at that. Homeowners, we can agree, right? We all have renters. We've all raised our hand to that. We know that units with renters in them typically are not always the best cap units, right? Anyone have, right? We have that assumption because there's no sense of ownership. So when we look at a condo association and we determine the rates, what a carrier does versus an apartment community, there's a sense of ownership there, and that's why condo rates are less than apartments. Somewhere between 25 and 35% of rented unit percentage carriers start to adjust the rate going closer to an apartment. It's not set in stone, and there can be some very, very nice communities that have an average rent of $2,000 and $3,000 a month, where they might let that even go up to 40%. But it's somewhere around that 25, 30%, they start adding premium to your quote, because the risk for loss is higher in rented units than it is in co-owner occupied units. At some point, you just get to an apartment rate. Yes?
If you, for instance, our complex, we have cap 28, and now we've redone it and the cap is 18, should we?
Yes, absolutely. Especially if they are, and again, it's not a surcharge. They don't say rental surcharge, right? But here's how commercial insurance is quoted. You have a base rate, we'll call it a book rate. For every $1 million of coverage, we need to collect $1,000 of premium. We can adjust that rate based on how nice your community is, the location of the community, how proactive the board is, how good the management company is, because those all affect losses. How many rentals you have. Well, we may want to give you 25% off that base rate, but because your rentals are high, our underwriter would only allow us to give you 20%. Well, now your rentals have come down, we can go back and negotiate.
What if the city also has rentals? Inventory.
That helps as well. Yep.
Yeah.
Still, for the most part, carriers somewhere between 25 and 30% start to ask more questions. There are carriers, we represent them at 35 to 40%. Travelers will not write you. They don't even offer to rate you as an apartment. They just say you don't fit our condo program anymore, so we won't insure you. Directors and officers, most of you guys are on the board in here, right? Everyone on the board, you have like the most thankless job ever of it all, the liability exposure in the world. And I know that's gotten better. The Michigan Nonprofit Act, and Steve will probably touch on this, has done some really great things for board members who are volunteers, and they've offered much more protection than they did back in the early 90s and 2000s. That's been adjusted. But there are still some things that can happen. So, directors and officers issues. The board before me messed up. Non-monetary damages. What if we're being sued, but there's no monetary amount? We're not looking for a monetary damage. Third-party discrimination or employment practices liability. Insured versus insured, and duty to defend or just indemnify. So 2 years ago, the old board fired the snow removal company in the middle of the contract because they found a cheaper rate with an old board member's son. When I got the mail today, I was shocked to see myself, along with the association, are being sued for breach of contract by the old company. I wasn't even on the board then. How's that going to be handled by your clerk? Do you have past, present, and future board member coverage? Non-monetary damage. You sit on the board of an association, has a great location on the water. You and the other board members own several units. You decide to vote on and change the rental rules to allow short-term rentals. All goes well. So the other co-owners that live there decide they don't like new vacationers coming in, being loud, damaging property every weekend. So they sue the board to reverse the vote and change the rules back. 3 years later, $80,000 worth of litigation. And it's still not settled. They didn't ask for any money. They just wanted the bylaws reverted back. That $80,000 costs the association money and the board members money. You have coverage for that. An employee for a lawn care company that the association hires made discriminating and degrading comments to a daughter of a co-owner every time he saw her over the course of months. The daughter needed to see a counselor. As a result of the degrading harassment, she quit the volleyball team. She stopped having her friends come over. The co-owner sued the board seeking damages for pain and suffering and emotional harm. Do you think the co-owner has a claim? No one has a thought? The co-owner has a claim. The board hired the company whose employee did that. It's third-party discrimination. Do you have insurance coverage for that? Most policies don't cover employment practices if the association doesn't have an actual employee. So that's problem one. Even if you have an employee, most carriers limit it to your physical employee, not the third-party employee you made a decision to hire through a contract. Insured versus insured. Jim's a board member at White House Acres. He convinces most of the board to vote in favor of building a multi-million-dollar clubhouse with a pool. It's going to be really pretty. John doesn't believe the association can take out that loan and build it because they'll never have enough money to pay for the loan. They'd have to raise dues almost $700 a month on the 12 units in the association. John lost the vote, but he still believes it's wrong. John's only recourse is to take the association board members to court and get a judge to enter an injunction because they're violating the fiduciary responsibility of the association. So he sues Jim and the rest of the board to stop this from happening. But who's paying that bill? A lot of policies have an insured versus insured exclusion, which means if the association sues the board or the board sues another member of the board, there's no coverage. The policy will not respond. They are both insureds, and it won't respond on either side. Our opinion is you want a policy that will respond to both sides up until one is clearly wrong or created negligence, and to then continue to defend and respond to the right party. Duty to defend versus indemnify. So duty to defend is different than duty to indemnify. Duty to indemnify is simply to pay or compensate an insured for liabilities that are covered. So they have to be covered to be indemnified. Duty to defend, actively defend or fund the defense of a claim that falls within the scope of covered liabilities. There's a slight difference there, but it's an important one. Almost all policies say the word duty to defend, but they have a clause that then says, if we would not indemnify you for this action, we do not have to defend you for this action. Well, harassment, that's an allegation. Right? Human rights violations based on sex, race, religion, those are allegations. Some companies will not defend you because that is not a covered claim. And that would be a really, really big issue. So you have to have a duty to defend that's very broad. The other thing you want is an independent clause. Most of the time when lawsuits come in, it's not one item. There's 8 items listed by the attorney. If one of those items isn't covered, a lot of carriers will throw out the entire suit and say there's no coverage. You want an independent clause that says we will treat every one of these claims independently of each other, and we will defend this one, this one, this one, and this one. But if you're guilty, we won't indemnify you of this one because it was a human rights violation and it's excluded. But that doesn't mean we won't still indemnify you for the other 7 items on this list. Broader than an indemnification clause, again, going back to the duty to defend. Just because it says duty to defend, we want to make sure that the actual definition is broad and that the definition in the policy goes on to state things like we have the duty to defend you even though we reserve the right not to indemnify you, and doesn't go on to say things like we have the duty to defend you unless it's for a claim arising on something we've excluded. Those are important things. My association indemnifies us, and most associations have a clause. Those who sit on the board, have you read the bylaws? Section in there that usually says the association will indemnify you, right? Unless you've done something illegal, they'll indemnify you. And that's great to have. But the board of the association sued for wrongful foreclosure of a co-owner. Documents of the association indemnify the board. They take on the defense cost and the indemnification of any judgment as their own. After a lengthy lawsuit, the association lost legal bills are about $75,000, and they're ordered to pay the wrong co-owner fair market value and other damages to the amount of about $425,000. So yes, we know that you as the board are indemnified, but the association still now has to come up with about $500,000. So will your policy covered you, the board, and the association as a named insured? Do you have association coverage on your directors and officers policy? So you want to make sure that your D&O policy will extend to the association as well. I think there was a hand in the back. So pretty short and sweet, but there's some big topics there that get overlooked a lot. They don't always get discussed when an agent presents the proposal, why we did things a certain way. Why, for instance, if you're with our agency, you'll notice a lot of you probably have Farm Bureau insurance as your property and your basic liability or general liability, but you don't have Farm Bureau for your directors and officers. Farm Bureau offers it. The only problem is it's the same one they offer to the guy who owns a flower shop and an office building. It's not very good. And they know it's not very good. That's why they know we don't use them. We use a policy and a program very specific to condo associations that we help build to make sure that those issues on the D&O are covered. So it's okay to have that, but you'll notice the things that we've done different a little bit there to make sure that all those issues are covered. And so when you have an agent come out to your board meeting, they have a proposal, those are the most concerning points. If you have a $20 million complex, building values, rebuild, and you have blanket coverage, whether you're insured for 21 million or 19 million or exactly 20 million, I'll just be honest, it isn't going to make a difference at the end of the day. Travelers, Philadelphia, these are all companies we represent. State Farm, we don't, but they will all rebuild your building when you have a loss that's covered. It's the basic things that their basic policy may not cover. Does the agent insure condos every day? Did they put all of the endorsements you need? Does your directors and officers step up when you actually need it? Those are the things that you guys have to ask the agent when you go and you have that meeting. Any questions or concerns? Yes.
I don't know, but is there any kind of a rating system, sort of like Better Business Bureau, where that ranks boards,
No.
gives a rating or a rating? Because I often wonder why isn't that in the
Yeah, there isn't currently. I know that when I sat on the Legislative Action Committee for Community Association Institute, that had been something the state had talked about. There's other states that have something very similar to that. Unfortunately, it gets very close to more of a Dun and Bradstreet, like credit rating.
Yeah.
And a lot of times the data they're pulling has more to do with did the association pay their bills on time than is it actually ran efficiently. So we didn't really see how that was going to give a clear insight into the actual board, and just haven't done anything with it since then. My advice for homeowners would be that you get a full copy of the bylaws, you ask for a copy of the financials. But you may not understand why the snowplow company's bid is $27,000 and it just seems high. But you don't really know as a owner what it's supposed to be. But at least you can see that there's reserves, right? And we have some money in the bank. So the likelihood that I come in, because the roads are done and the roofs are done, the likelihood I come in and we have $1 million assessment next year is probably pretty slim, especially if we still have money in reserve. Those would be things I think owners should look into and know about, but there's no actual rating system. How is that good? Yeah, absolutely.
Regarding the rental percent.
Yeah.
Because which is and placing a cap. But our problem is that there's enough rental that we get enough interest in changing.
Yeah. So what we've typically, I like to handle rentals separately from the rest of the bylaw resolution. Let's say, a lot of times associations are gonna redo their bylaws, and they're gonna redo a major bylaw review. Who's responsible for what, rentals, all kinds of things. And it gets super, super confusing, and then one vote determines a yes or no. So I like to break each segment out, have a vote on each segment. I would have the insurance agent come to the annual or the special meeting regarding that, discuss why it's important to have rental caps, and also offer a grandfather clause. So what we've seen a lot with grandfather clauses is typically the current owner, spouse, if they have a spouse, continues the same grandfather, and then one more generation. However, if it's ever sold or goes into 2 generations, the rental grandfather ends up. Nothing. We can go eat. Just thank you guys for coming in and spending 40 minutes with me. I know insurance isn't always exciting, but I hope we covered enough topics. And you guys shouldn't be the expert in insurance, that's our job, but at least enough to be aware of some of the things you should look out for. And prices can vary widely. We see it all the time, even on ours. And I will tell you that the rate you have, we could probably do for less, but you would not have any of those coverages. And so just because we can get you a lower rate doesn't mean it's without sacrificing some coverage. We just don't want to do that. Thank you.